Welcome to the Retirement Compass radio show. I'm Mike Bauer, your consumer advocate, and today's show is all about the retirement blind spots that most people don't see coming. Not the big stuff, not market crashes that grab the headlines, not recessions, not the big D depressions, none of that. We're talking about like the trickle effect, the quiet, slow-moving threats that can, over time, do a great deal of damage. If you want to get ahead of that potential damage, give the folks at Stonebridge Financial a call. Stonebridge has offices in Kearney, Grand Island, Omaha, and Lincoln. You can connect with them remotely wherever you are as well. Stonebridge Wealth Systems can be reached at 866-295-5146 or online at stonebridgeiwm.com. Joining me today is Zach Vancas, financial advisor with Stonebridge Wealth Systems. Zach, great to have you on the show today, man. Thanks so much.
Hey, good to be here, Mike. Highlight of the week.
All right, here's what we're going to jump into today. And like I said, there's the big stuff, but let's talk about some of the little stuff. And maybe it's a little uncomfortable, to be quite honest. Let's get a little uncomfortable here. Not divorce, job loss, and market crash. Those are all uncomfortable things, but those are the big things. Let's get a little closer to home. The slow damage, the stuff that we should deal with, we just don't, right? Financial procrastination. Is that something that you encounter a lot of times? Is people just constantly putting stuff off, moving the goalposts?
Mm-hmm. Unfortunately, it's a pretty common thing I run into, not just in finances, but in, really everything in life. Now, I say this as somebody who is a procrastinator at heart. So yes, when you're going through school, high school, college era, or at your job, procrastination's not that bad because you have a deadline, right? There's a thing you have to achieve by X day. And when we all get assigned, the term paper in college, and you've got 3 months to work on it, and it's due the last Friday of the year, when are we all doing it? It's Thursday night, right?
Yep.
But that's because it's due Friday. Unfortunately, when it comes to personal finance, there's no deadline. There's no Friday at 11:59 p.m. looming over you. And because of that, when people get to certain facets of life like finance or estate planning, there's not a deadline. And so they don't start. There's always tomorrow, right? There's always going to be tomorrow. It's not due. And unfortunately, when it comes to the little things in personal finance, time is your number one asset. Yeah, I know that a majority of people listening to this show right now are probably nearing retirement age, or they are retired. Hopefully we got a couple, 20-year-olds out there listening now. But because any dollar that you can invest at age 20 has the potential to grow to upwards of $80+ by the time you're 65 just because of compounding interest. People think, hey, it's not possible for me to save millions of dollars. If you start young, it doesn't take that much a month, because you have that massive compounding effect of time. If, on the other hand, you wait till the age of 25, that dollar has the potential to grow to $44. That's a huge difference between 20 and 25. If, however, you decide, retirement, that thing, that's an old people thing. I'm not going to start saving for retirement until I'm in my 50s. Your wealth multiplier at that point could be maybe $3. Depending on obviously your rates of return, right? It is a tremendous difference. So if you want to save a few $1,000,000 and you only have a wealth multiplier of $2 to $3 or 2 to 3 times your dollar, okay, well, you better put away $500,000 or more if you want to have a few million. Whereas if you started in your 20s, that's a big difference. And, I don't say that. Now, don't hear, okay, well, I am 50, so I guess I'm screwed. That's not what we're saying at all. There's always still time. And any dollar you can save now, it's worth something, and it's worth something more, right? The last thing you want to do is get to age 65, age 67, whatever it is, and you want to retire. And now is the time we start thinking about it, planning for it, getting ready for it, because you've kind of made your bed at that point, and there's only so many levers we can pull at that point.
What are some of the things that people listening right now probably have sitting in the drawer in their desk, or maybe it's up on the top shelf in the closet, it's been there for years? What are some of the things that maybe was a great plan 10, 20, 30 years ago and probably needs to be dusted off and actually looked at again?
Yeah, there's a lot that of good intentions or good ideas that start that people kind of let fall by the wayside. One of the things that we see quite a bit when people come in, especially when they're nearing that retirement era, is while you were working, you had a 401k. And there's a lot of people who open a 401k at a job and then they switch jobs. Gone are the days when out of college you get a job and you work there until you retire. I think last statistic I saw, the average American today switches jobs roughly 12 times in their lifetime, which means potentially you've got 12 401ks lying around that you didn't do anything with. And I've seen it. I've had clients come in and we've spent I remember being here one time till like 9:30 at night with a client, a 5-hour meeting of hunting down 6 401ks that they thought they had. And they got like a thing in the mail one time, but that company's out of business. And we're talking like for this client, it was hundreds of thousands of dollars that they just like lost, forgot about. Because I mentioned earlier that compounding effect, they worked somewhere for 5-6 years when they were 20 and had a few $1,000 in there and then got decent returns for, 40 some odd years. And surprise, surprise, you've got tens of thousands of dollars lying around that you didn't know about. The flip side of that is that 401k wasn't invested right, and that $2,000 you had sitting in cash could have been invested, but wasn't for 40 years. And the opportunity cost on that, we had a client come in. She worked at a big healthcare conglomerate as a charge nurse, did really well, right? Did everything right, saved a bunch of money, put all her money in her 401k. And when looking at a list of funds, saw one of them titled Stable Value and thought, well, I like value. I like stability.
Those are good words.
Yeah, those are good words. I'm gonna do that. It's a savings, like it's a glorified savings account. She got like 1% interest maybe.
Oh man.
And I don't remember if we told her like exactly, but we did the math on basically how much did that mistake cost? Like it was $1 million that could have been. So those are the things that like you don't think of it, right? I started a 401k, put it over there, forget about it, don't worry about it. Kind of, like you said, put it on the shelf, let it collect dust. That was $1 million 30-second decision.
Don't wait to have that discussion. Don't wait until it snowballs into something that's that big. Give the team at Stonebridge Wealth Systems a call, 866-295-5146. Visit stonebridgeiwm.com. You can schedule a complimentary first visit with them as well. If anything in our conversation today is prompting a question about your own plan, or you're thinking about, do I have those 401ks? Is that estate plan, and that Zach, we'll get to that here in a sec, is that estate plan that's been sitting, in the desk for years collecting dust? Do I need to address that now? Why do I need to address that now? Give the team at Stonebridge Wealth Systems a call. Again, 4 locations conveniently throughout Nebraska, or on the phone at 866-295-5146, online at stonebridgeiwm.com. So let's talk about that estate plan, because that's something that I'm sure somebody listening is like, I've got one of those, I'm good. Mm-hmm. But Zach, think about your life. Anybody listening, think about your life. How different was it 10, 15, 25 years ago? A lot can change in that time, and you guys can help people keep that estate plan up to date if you've got one. And if you don't have one, it's a good time to start.
So we do a couple of workshops here, around Nebraska, and one of the topics is estate planning. And the fun example, fun, air quotes fun, depending on how you want to look at this. So come with me on this journey. Fun example we like to give is there was an individual who worked at, I think it was like Johnson & Johnson. I don't remember exactly. He got hired there when he was 20. And when he got hired, he got a little 401k that he opened up, put all his money in, forgot about, just like we talked about in the last segment.
Yeah.
And he had a girlfriend at the time, a lady friend, and he put his lady friend down as his primary beneficiary. Okay, makes sense. He's like 20. Well, he ended up working his whole career at this one company. Okay, and in that time, he had broke up with the lady friend, got a new lady friend, I think got married, had kids, got divorced, got a new lady friend that he was living with for years and years and years and years. And stated he didn't have common law marriage, but basically like it was assumed that these two, that was it forever, right? He passes away. Guess who got all $1.7 million? The ex-girlfriend.
Yeah,
whom
not
he
the
hadn't
kids,
seen.
not the wife, not a family member, somebody that he's probably just connected to on Facebook from the past. That's it.
He has not spoken to this person for 40 years.
Oh my goodness. Facebook didn't even exist. So never mind.
That is why you need an updated estate plan, because he did it right. He designated his beneficiary. But like you said, life changes. And there's a lot of nuances to that. You have a will, but when it comes to all your individual like direct beneficiary accounts, think basically all your money, 401k, IRAs, your life insurance, bank accounts, right? Those are all direct beneficiary assets. Meaning if you have a beneficiary designation form on file, so his lady friend, his ex-girlfriend being the beneficiary, even if he did have an up-to-date will that said, hey, all my stuff goes to this person, guess what? Your beneficiary designation form trumps your will. So it didn't matter. She got it. And of course, everyone and their mother contested when he passed away. It doesn't matter. It's black and white. Like law says, beneficiary designation form over will. What's the beneficiary form say? Jane Doe. Guess who gets it? Jane Doe.
Yeah.
So, my advice is obviously check your stuff. Make sure that you're not doing that. The last thing you want to do is disinherit your kids out of millions of dollars to give it to some ex-girlfriend that they didn't even know existed. But silver lining in this story is maybe you are that ex on some old retirement account that you don't know about. So there's always a chance.
Then you've got to like go online and look for like unclaimed property or something like that. I mean, all of a sudden you get a thing in the mail that you're probably like, oh, another credit card thing, I'm just going to throw, it's an election year, another election thing. I'm just going to rip this up and throw it out. Hopefully if you're that very small percentage that you're that Jane Doe, you don't do that. Hey, look, don't procrastinate. Financial procrastination, whether it's your estate, it's your will, whether it's updating your 401k, as simple as, Zach, really, to be quite honest, in terms of designating beneficiaries, that really is the first step, right? That's designate the correct beneficiaries, update those things. And the team at Stonebridge Wealth Systems is able and happy to help you figure it all out, because you don't want that trickle effect, the procrastination, to really become a big deal. It's a small threat, but you know what? It's also one of the most fixable problems, one that actually is easy to fix if you take the time to take a look. And the team at Stonebridge can help you with that. Get some time with them. 866-295-5146. That's 866-295-5146. Or you can always go online to stonebridgeiwm.com.
Did you ever think your retirement would be shared with our government? It's true. Your traditional 401k, IRA, pension, or similar retirement accounts are like a partnership with the IRS. Simply put, they want their tax dollars, and you have them. With our latest tax calculator, you can plug in your own numbers while sitting at home. To find out what your future tax liability could be, scan the QR code or go to stonebridgetaxbill.com.
Thank you so much for listening to the Retirement Compass radio show. Stonebridge Wealth Systems has offices in Kearney, Grand Island, Lincoln, and Omaha. You can obviously connect with them remotely wherever you are. Joining me today on the Retirement Compass is Zach Vancas, financial advisor with Stonebridge Wealth Systems. Now, Zach, for decades, the retirement formula seemed pretty straightforward, right? You put money in your 401k. If you've got a pension, that's great. Diversify across stocks and bonds, and let time do the work, right? Compounding interest, wonder of the world, great. But that formula may be changing specifically with the 401k wrapper. And I'm gonna use that to kind of phrase it as a wrapper, because the 401k can contain investments depending on your employer and what have you. I'm sure you have some level of control over that, but how are things changing right now with that wrapper that is the 401k?
Yeah, I would say that the big thing that's really changing with that wrapper is a lot of people right now, you hear a lot of headlines right now about, well, they're changing what you can put in that. The most recent administration was talking about how they want to add crypto options to your 401k. Additionally, you'll see things like, the recent SpaceX IPO, NASDAQ changes the rules on how long it takes for a company like that to get introduced into the NASDAQ 100. And they lowered that down to 15 days. And the reason for that was, SpaceX wants exposure to that market, right? There's tens of trillions of dollars sitting in 401ks. And when you have a 401k, your plan administrator, your HR department picks what you get, right? Like you can't go put your 401k all in Bitcoin because that's not an option. You maybe have a dozen mutual funds available from like one specific company. Well, SpaceX wants access to that. Everyone, not just SpaceX, wants access to that capital. So NASDAQ lowers the requirement. So if you have any type of a NASDAQ fund in your 401k, which is an option, right? S&P 500, NASDAQ, Dow Jones, international, bonds, like these are all the big broad categories you think of are your options. Well, now suddenly, you own SpaceX in your 401k, right? You have access to those trillions of dollars locked up in retirement accounts. So everyone's trying to get access to them. That's one big thing that's changing. There's also, we want to put private equity in it. Like everyone access to this giant pool of funds. B, there's a lot of effort into changing or giving people more options to just having a 401k, right? Different ways to save. Because like you said, Mike, the longest time was, okay, hey, put money in your 401k and do nothing. Like that was it. And really before that, the longest thing was you work at a company, you get a pension, and your company's in charge of taking care of you for the rest of your life, right? But 1974, something big happened. I mean, there was a few big things that happened, right? Like Rubik's Cube came out, Burger King, have it your way slogan came out. What else happened? Watergate happened. This is before I was born, so I'm kind of going off textbooks. Bear with me. But, important things happened in 1974. But the big thing that happened was the ERISA Act was passed, Employee Retirement Income Security Act. What that did is it was the birthplace of the IRA. Because, before the effort, the responsibility of planning for your retirement fell solely on your employer. And there were some pension funds that went broke. A few things went bad. And so we decided, okay, well, hey, we can't have people rely solely on their company. Okay, it's rooted in logic, right? But what happened is the pension went the way of the dinosaur. And these IRAs came out. And then shortly after that, we amended the Internal Revenue Code to add Section 401, Paragraph K. The 401k was born. Yeah. And where we are now is we've taken everything away from the pension and put everything in the 401k, right? The responsibility of retirement that was 100% on your employer was shifted to the, no offense, people least qualified to handle it. It's you, right? It's the teacher, it's the farmer, it's the car salesman. It's your job to navigate all of these legislative risks, to navigate all of the stock market, bonds, this, that, and the other. What's going on in the laws? How do I do this? What stocks do I pick? That is all on you now. That's been shifted away from the company to now you, the individual. And obviously, there's some cracks in that system. And so now they're wanting, it's kind of shifting again, right? People aren't taking advantage of the 401k. So we're starting to implement rules where if you start a new job, you're automatically enrolled in it. You can opt out, obviously. But if you do nothing, you get enrolled. And then every year, your contribution goes up a little bit automatically. Again, if you do nothing, you're still saving, you're saving a little bit more. They're trying to add different funds to it. Now they're expanding out. New types of accounts are coming. Obviously, the Roth, that came out in like the 90s. So that's not new, but it's newer. You've got Trump accounts now. Like they're trying to diversify out. There's different ways to save. Now, I'm not saying the 401k is bad. Don't hear that from me. But hear that there are a lot of alternatives to this one magical little plan that was supposed to do everything for us, and suddenly it's not.
So the 401k, it's a wrapper. And then underneath that, there's a lot of, you're talking about mutual funds, and then there's a lot of different, so there's a lot of different levels to this. How often do you encounter somebody? I know this might be kind of a loaded question. I think I know where we're going with this, but how often do you sit down with somebody who knows exactly what's in their 401k?
Rarely.
Yeah. That's what I thought.
Unless it's something along the lines of, I shouldn't say rarely. They occasionally do, but at a high level, it's, I own a target date fund. Okay. I mean, that is true. Yeah. But, there's a lot that goes into a target. Like the way a target date fund works for those listening is you buy a fund with a target date of 2065. That's the year I want to retire. And, right now it's not 2065 or, a couple days out. And so it's mostly stocks, maybe a little bit of bonds. Every 5 years or so, it's automatically, regardless of what's happening in the market, doesn't matter. It's going to sell some stocks, buy some bonds. And every 5 years, you're going to trickle to the point where, like you said, Mike, the old goal was put money in your 401k, don't touch it, invest in diversified stocks and bonds, and it should probably be safe, I think.
Let the magic happen. Just sit back, and it's a miracle.
Just suddenly you're going to wake up with millions. And there can be a reality to that. Like if you're diligent about saving and you're putting away 15 to 25% of your income in a decent diversified portfolio, like a target date fund, and you do nothing, you'll probably end up okay, like at the end of the day. But, that target date, it's extremely mechanical in how it operates. Like I said, it doesn't matter what's happening in the market, what bonds versus stocks are worth. If there's a big market correction and the calendar day comes to say, hey, sell 10% of the stocks and buy bonds, and we're going to sell the stocks at the bottom and buy bonds at an all-time high, guess what? That's happening. Not because somebody made a bad decision, but because it's just a black and white mechanical outcome. And so, there's better ways to do that. But like you said, most people don't know, what's in it. Like the stable value example I gave, she had a 401k. She did it right. She just didn't know what it was invested in exactly.
But those are good words, though. Stable and value. The good words.
They are, but most of the time it's literally just like a savings account. Like you're going to get 1% interest. I mean, if it's at certain banks who I don't want to name, you're going to get 0.01% and they're proud of it. But I'm not naming names.
I have gotten those emails before of you've been with us for 10 years. We're offering you a 100% boost on your savings. And I'm like, great. So I get 0.02% for the next 3 months. You guys are so kind.
Yeah, you're going to get 11 cents a decade. Yeah.
Well, for anybody listening to the Retirement Compass radio show right now who doesn't know what's inside their 401k or their IRA, because you've got that. You sign up for it. As Zach mentioned, when you got your job, HR, you signed up for it. If you didn't waive coverage, if you didn't decline, you're in that 401k. But you might actually not have any idea how much risk you're carrying, or the risk from years ago when you started your job is a lot different than the risk today. Give the team at Stonebridge Wealth Systems a call, and they're going to help you figure that out. Specifically with risk, they got a great website, stonebridgeriskquiz.com. You can go online, a quick complimentary risk assessment. It's fast, it's free. It'll give you a clear picture of where you actually stand right now in terms of risk exposure in the market and with your hard-earned savings. You can always give them a call at 866-295-5146. That's 866-295-5146. Zach, big picture. I want to kind of zoom out, all the way out, 30,000-foot look. What's the most important takeaway for somebody who's just tuning in right now when we're talking about what's actually in, how the sausage is made, right? What's inside the 401ks?
Yeah. Your 401k, like I had said previously, it's going to be a curated list of maybe a couple dozen funds. Some of you may have a self-directed 401k option, which means you have access to basically the entire market. But for the most part, it's going to be a curated list of a few mutual funds or ETFs that are fine. I mean, they're not terrible. You'll have, big U.S. companies, medium U.S. companies, small U.S. companies, international, the emerging markets, you're just broad category mutual funds. Those are going to be the options available. And there's nothing inherently wrong with that. But the analogy we like to give is, let's say you want to buy a new pair of shoes, right? You could go to the Nike outlet up in Gretna and guess what? You're leaving with a pair of Nikes. Yeah, they've got colors and yeah, they got a few models, but you're getting a pair of Nikes. That's a 401k. Or you can go to Scheels and get literally every brand of shoe imaginable.
Ever made.
Yeah, ever imagined. And if they don't have it in store, guess what? They'll just order it, right? You can get, this sounds like not sponsored. You can get Hoka's, On Clouds, Asics, Brooks, my go-to. Again, not sponsored. I can't think of another brand of shoe, but or Nikes, but any brand of shoe.
I'm currently wearing Allbirds, which is now going to become an AI company. So I think I have a collector's item on my feet right now.
That's a doozy.
Yeah, right.
That's a mess. But anyway, so that's like an IRA, for example, or a Roth IRA or a brokerage account. You have access to everything. So I'm not saying don't use your 401k. Typically, what we like to recommend is, okay, you have a 401k. Do you have a match? Yes, you do. Okay, get the match.
Yep.
That's free money. You put in 3%, the company gives you 3%. Guess what? You doubled your money with zero risk. I'm going to take that deal. Okay, you doubled your money. Now, let's say you want to invest the 15 to 25% that we like to recommend. Okay, let's say it's 20%. Well, that means you still need to do another 17% in savings. Do that in an IRA or a Roth IRA. Now, it's based on your tax situation. Important to sit down with somebody to figure out which, but do that in an IRA because you have the flexibility. You can invest in whatever you want. You have access to a lot more different options in doing that. If you still have money and you haven't hit your 20% goal, then you can look at alternative investments like maybe an HSA if that's available. You can look at depending on like if you own your own business, that's where something like a cash balance plan, like there's other stuff, or you just simply go back to the 401k and, you hit your maximum 20%, but you want that IRA or that more flexible investment option available. You can invest in like a taxable brokerage account as well, but you don't have the same tax advantages. So it's nuanced to like what makes the most sense for you, which again is why it's important to sit down with somebody to discuss those options.
And it's also important to sit down with somebody and discuss the options before you start tinkering around in the website for your 401k and clicking boxes. And, I heard this, as you mentioned it. Oh, a stable, okay, great, stable value. Before you start clicking on boxes, find out what's behind that wrapping. What goes inside your retirement accounts matters. Those options are potentially expanding in the future. And having somebody who understands your goals, your timeline, and your risk tolerance is more important now than ever. If you'd like a second set of eyes on your portfolio or just to take a look at your current 401ks or IRAs, give the team at Stonebridge Wealth Systems a call, 866-295-5146. That's 866-295-5146. You can schedule an in-person visit at one of the 4 locations, or you can always go online to Stonebridge IWM, do the same thing, or even set up a virtual visit if that's more convenient for you. We'll be back right after this.
Hi, I'm Jeremy Gove with Stonebridge Wealth Systems. Are you taking too much risk with your retirement or not enough? Most people really aren't sure. That's why we created the Stonebridge Risk Quiz. In just a few minutes, it helps you discover your personal risk tolerance. Your score could reveal why your investments sometimes feel too aggressive or maybe too conservative. It's quick, simple, and eye-opening. Scan the QR code or visit stonebridgeriskquiz.com to see if your money matches your mindset.
Thank you so much for joining us on this edition of the Retirement Compass Radio Show. I'm Mike Bauer here with Zach Vancas of Stonebridge Wealth Systems. And Zach, for many families, retirement, it begins with a major event, selling a piece of land, leasing out acreage, selling off livestock and equipment. And we've talked about that before in terms of want to leave something as a legacy for my, future generations. But on the other side, flip the coin. Let's look at the other side. Somebody who is inheriting a farm, a piece of land, acreage, livestock. What are some of the potential hidden tax implications of a very generous but significant inheritance?
So it depends very largely on what you inherit, in that there's a lot of underlying things that nobody thinks about. The broad overarching side of the inheritance equation is, okay, you've got federal, you got state. Inheritance or estate taxes. So the federal estate tax right now, the exclusion on that is like $15 million in change per person. So that means, a married couple, you can basically leave like $30 million to your kids. We're probably not, most people aren't going to hit that line. Back in the day, that was obviously a lot lower. And that's where the, big push for all the different types of trust, tax shelter for inheritance plan, yada, yada, yada. That's where that all came from, is because that limit used to be a lot lower. But right now it's like $15 million a person. On the state side, so for Nebraska specifically, there's a $100,000 exemption, and then it's a 1% tax on everything above that. So let's say you give your kid $200,000. Well, the first $100,000 is tax free, and then they'll pay 1% of the next $100,000. So they'll pay $1,000 in Nebraska state inheritance tax. And then after that, it's theirs. If it's land, agriculture, obviously there's responsibility for property taxes, taxes on the income, so on and so forth, just as if it was yours. Big things to think about on like the land agricultural side is, the cost basis. So let's say you bought land, back in the day. Like I just talked to somebody the other day, their dad bought this plot of land in like the 30s. So he probably paid like 2 raspberries per acre to buy this, right?
And
today
a wooden nickel.
Yeah. Today it's worth, I don't know, $15,000 an acre, whatever farmland's worth.
Yeah.
Depends on where you are in the state, obviously. That's a massive capital gain that she's going to have to pay when she inherits it. Not quite, because when you inherit land, you get a stepped up basis. So the value of the land is now what the value was at the date of passing. So you don't have to worry when leaving land or inheriting land like that about what the capital gain is, because if you inherit it, now if you were gifted it early, that changes the equation completely. But if you just inherit land, you get a stepped up basis and you can just turn around and sell it for no profit. Obviously, you still have the inheritance side, but there's no profit. The big side of the inheritance equation tax-wise is if you were to inherit any type of tax-deferred asset. So think 401k, IRA, 403b, anything like that. The downside with inheriting those is when the government passed the Secure Act 2.0, they eliminated the stretch rule. And so now you have what's called the 10-year rule. So let's say your parent left you a $100,000 401k. You have 10 years to empty that. And every dollar that comes out of it is fully taxable to you as ordinary income. So you could take all $100,000 day one. Well, congratulations, you have a $100,000 income you get to pay taxes on. You could do nothing, double it to $200,000. Okay, you take it all out in year 10. Congratulations, you have a $200,000 taxable income. Or you can take it, piecemeal year after year. How you do it, you have flexibility on. It's important to sit down with somebody. But, you got to think that's going to tie into, let's say you got some land and you got an IRA and you got some taxable assets and maybe there's some life insurance. Well, okay, the life insurance isn't taxable. That's good to know. But you're getting income on the land. You have an inheritance tax. You got to pay property taxes. Now you have this IRA money that you somehow have to get all of that out while getting income from the land and income from your current job. That can turn into a little bit of a messy tax picture. And the important thing when you inherit like a large sum like that is you're going to want to sit down with somebody and plan through, well, how am I going to do this? How do I navigate this? Because everything's about to change for you tax-wise.
And Uncle Sam doesn't deserve a massive chunk of that, of your hard-earned legacy or your inheritance, just because of the life event that happened. You need a written tax mitigation plan. Give the team at Stonebridge Wealth Systems a call, 866-295-5146. You can schedule a complimentary tax efficiency review with Zach and his team. You can also check out the math yourself, right? They have a great website they built called StonebridgeTaxBill.com. That's StonebridgeTaxBill.com. You can use the tax tool calculator. Don't wait until it's too late. Call or click today, 866-295-5146.
Hi, I'm Tim Kohanic with Stonebridge Wealth Systems. You've worked hard and saved for retirement, but how much of it will you actually get to keep? If your savings are in a traditional IRA or 401k, Uncle Sam has a claim on every withdrawal you make. And with tax rates expected to rise in the future, the cost of waiting could be significant. A Roth conversion may help lower your future tax burden. Want to know what your liability could look like? Scan the QR code or visit StonebridgeRothQuiz.com to take our Roth conversion quiz today and see if a conversion makes sense for you.
Welcome back to the Retirement Compass Radio Show. I'm Mike Bauer, consumer advocate, and joining me today is Zach Vancas, financial advisor with Stonebridge Wealth Systems. Stonebridge has 4 locations: Lincoln, Omaha, Grand Island, and Kearney. And Zach, I want to talk to you. This is something that we all do, right? You're not supposed to. But when you wake up in the morning, the first thing you do is you grab your phone, you start looking at stuff on your phone. If you're responsible, you're looking at the calendar, what's happening today. But let's be honest, most of us are probably, scrolling some sort of social media and seeing what's going on in the world. And then you start getting, I had one pop up the other day, and my algorithm, I'm a dad, so I got a bunch of Disney stuff. Mm-hmm. I'm a big sports fan, so I got a bunch of sports stuff. And then, that financially, something popped up, and it's some dude I've never heard of screaming into the camera, yelling about his triple double lock hammer of the week, perfect pick, buy now, and I'm like, whatever it is, you click up on the button, go, ignore this, do not, I'm not interested in this ad. How did this get to my algorithm? But there's so many financial influences out there, and they are convincing. They sound believable. They speak with confidence, even if their advice may not be anywhere near applicable to somebody's real retirement situation. Are you cleaning up these messes all the time at Stonebridge?
Constantly.
Oh man.
We were talking off script recording, whatever you're going to call it here, about how I'm probably going to get angsty this segment, because it's this constant battle that we'll run into. Admittedly, it's with the younger generations. Like, yeah, okay, I get, I'm part of that. Sorry about it. We're not the generation that put carpet in bathrooms, but every generation has its fault, right? And so people come in all the time, and the reason why, you said it there, is they seem so believable, they seem so convincing, even if their advice isn't that good. And the reason is, the ones that are successful, they're just good at talking. They look good, they sound good, and people are drawn to that, A, but B, people are drawn to the things they want, right? Everybody wants to be rich for not that much effort. Like, if I told you, hey, you can go like vacuum, for those of you that have been to the Lincoln office, it's not huge. For those of you can vacuum the office for me in 5 minutes, I'll pay you like $10 million. People are going to jump all over that, right? And, you tell them, hey, you can become a millionaire day trading. It takes, I'm a millionaire and I only did it 5 minutes a day. And here's how you can too. Buy my course, right? People want that. They want the success with easy effort. And when they see that's an option, they're going to be drawn to it. The problem is, if it sounds too good to be true, it probably is, right? And I look at it and like the best judge I have is the most basic economic principle that we were all taught in middle school, and that's supply and demand. It's if you can start a drop shipping business out of your garage for like a $5 setup cost and make millions, why is everybody not doing it? Like if it's that easy,
right,
then just do it.
Yeah, everybody would. Everybody would be.
And if everyone is doing it and it's that easy, guess what? It doesn't pay that much. Like it doesn't. That's why you can pay your next door neighbor's kid like $8 to mow your lawn, because there's a bajillion kids in your neighborhood mowing lawns, right? Like it's just supply and demand. You're not going to pay that kid $500,000 because there's 7,000 other kids that'll mow your lawn for free. That applies to all these scams. Like if it's that easy, it's probably not going to work.
I think we hear this a lot of times and people can get political on it, but, doing your own research, right? Oh, I did my own research. Look, if you're doing your own research online and you're not quite sure whether that actually any of it applies to you or that magical formula that some random person on the internet is selling out there is going to work for you. Look, this is a great reason to sit down with a professional like the folks at Stonebridge Wealth Systems, 866-295-5146. That's 866-295-5146. Give them a call, set up that first conversation in person. You can sit down with them. You can do it virtually as well. You can always also go online to stonebridgeiwm.com. No cost, no obligation, just clarity that you're not going to get from somebody screaming into an Instagram video. Okay, you briefly just kind of casually brought it up. You said that somebody online is saying, buy my course. Is that a red flag? Like if I'm watching a video and somebody's trying to sell me something in that video, buy my course, subscribe to the premium, level here, is that a red flag? And what are some other red flags that catch your eye?
I'd say the course thing is a big red flag for sure. Now that doesn't apply to everything. There's obviously good courses out there. Dave Ramsey's got his Financial Peace University when it comes to getting out of debt. I think that genuinely is a good course. What jumps out to me though, like my antennas definitely go up if I hear buy my course. And especially if it's tied to like some of the other red flags of, it's really easy. They became wildly wealthy by doing it. It's not that hard. Like I said previously, okay, if I can make $10 million and it takes me 5 minutes a day, as the kids say, that sounds sus. Like, probably not. And there's a course tied to that. Like, everything about that screams no. A lot of it too comes from like, follow the money. Why are they selling a course? Like at the end of the day, if somebody's trying to tell you, hey, you need to start a drop shipping business and I'm going to show you how, you're competing with that guy if you open a drop shipping business. So what's his motive for telling you to do it? And yeah, it could be the goodness of his heart, but let's be honest.
Yeah, I was going to say, I'm not buying that.
Doubt it. It's because he's not making money drop shipping. He's making money selling you a course about how to do drop shipping. Same thing with day trading. They're making money. Like 97% of day traders lose money. And at the end of the day, if somebody found a way, and they're like, oh, I average 80,000%, return a year, every year, and have for the whole time, why do you not own a multi-billion-dollar hedge fund? Like, why are you just in your garage? Like, I'd give you all my money if it was true, but it's not. That like you're talking to these guys on Wall Street that spend tens of millions, hundreds of millions a year on research, algorithms, computer trading platforms, are inferior to your little garage laptop setup that you're selling a course on, right?
They've got a good camera and one of those ring lights with good lighting. Like, right. That's pretty good.
Yeah. And, like some filters are thrown on, good editing. Yeah. It's just, it angsts me because it's so fake. It's so phony. If you follow the math, it's just not true. Like, it just doesn't work. And so when you hear outlandish thing, I mean, it's always the age-old thing. If it sounds too good to be true, it probably is. Like, if somebody's saying, hey, I have beat the greatest investors on the planet every year my entire life, doubt it. Like, no, you didn't.
Yeah, you wouldn't be on Instagram. You'd be the headline news story on CNBC and Fox Business and everything. Wall Street Journal would be doing an entire paper on you. Yeah,
like if you're alleging that you can beat Nancy Pelosi every year, that's a little sus. Now, the fact that Nancy Pelosi beats all the other investors, that's also a little sus. But insider trading's fine in Congress. So, not to get political. So, yeah, it doesn't make sense. Like you said, why are you on Instagram when you could be managing the biggest hedge fund on the planet?
Okay, so for somebody listening right now who's listening to us on the radio, or you're watching the podcast, okay, what's different? I mean, right now we're talking about don't listen to these guys online and stuff like that. What's different between our conversation here, Zach, and the people that are listening and saying, this guy on the radio, this guy on, I see on TV sometimes, this guy on the podcast, on my phone, maybe you're watching it. What's different between our conversation and those guys?
So, yeah, like I said, don't listen to anybody on the radio, TV, podcasts, or YouTube unless it's Stonebridge Well Systems, which probably sounds like a red flag, but bear with me here. No, I say that tongue in cheek.
Wait a second.
Yeah, I say that tongue in cheek, obviously. So, we're licensed financial advisors. Okay, you're going to be hard pressed to find actual licensed financial advisors on the internet giving advice. All the other, Grant Cardone, TikTok guys, not. But I would say the big piece of advice that we give that differentiates us from everybody else is we don't give any guarantees, right? I'm not guaranteeing you anything. I can't legally, and in actuality, I can't. And B, we don't give that specific of advice on the radio. Like, we obviously give advice all the time, but our advice is always with an asterisk, with a nuance to it, right? It's genuinely or generally good to say you should probably get out of high interest rate debt, right? You should probably save for retirement. You should probably look at maybe a Roth IRA because of tax reasons, right? But we're not making blanket statements like you need to do a Roth conversion every year at this percent, pay the taxes out of this and do that. And we're not giving that advice over the radio because it's different for everybody, right? I can't make a blanket statement like everyone should file for Social Security at X age. I can't do that. Like, because that's not true. That doesn't make sense. But all of these influencers that you see online, that's all they do. Because at the end of the day, like, our viewership isn't quite as good as like Grant Cardone's is on YouTube. Why? Because it sounds a lot better to say, hey, if you do this, you'll be a millionaire than, well, if you listen to me for an hour, I'm going to talk about how you could do X, Y, Z. But there's some nuance to that, but it depends on your situation. So you should come talk to us, right? People don't like that. It doesn't sound good, even though that's reality. Having nuance to it. Like, if somebody asks me a question, they expect a yes or no answer. And unfortunately, my answer to basically every single question is me asking you more questions and saying it depends. Now, I can get you an answer, and I will get you an answer, but it's going to be different for everybody because of a bajillion different reasons.
Yeah, I mean, there's opportunity to learn on the internet, right? There's, all of the knowledge of the, history of the world is at your fingertips in your phone, but that can't build you a retirement plan.
Yes.
And when the stakes are as high as your entire life savings, the nest egg that you've worked so hard to build up, the difference really matters. And when you sit down with Zach or a member of the Stonebridge Wealth Systems team, and you're asking questions, and they're asking you those questions back about, okay, well, what do you want to do? What do you want your life to look like? Sometimes it is good to answer a question with a question, and that's their job, to figure out your situation and how you want your life and your retirement to look. And again, that consultation, the first one, it's complimentary. When you go in there, you have a conversation with the team at Stonebridge Wealth Systems. There's no cost. There's no obligation. You aren't signing up to be a client. They aren't signing up to take you on. At Stonebridge Wealth Systems, you can have that first conversation at 866-295-5146. That's 866-295-5146. Have your calendar with you when you're calling so you can get slotted into a good time. You can always go online and kind of do it on your own. It's StonebridgeIWM.com. We'll be right back on the Retirement Compass.
A captain can navigate the open ocean. Calm days, stormy nights, they've seen it all. But when the ship reaches the harbor, everything changes. There's narrow passages, shifting tides, and hidden rocks. That's when the harbor master steps aboard, a specialist who knows how to bring you in safely. I'm Tim Kulhanek with Stonebridge Wealth Systems, and we're harbor masters for your retirement, guiding families through life's most important passage. Call the number below to schedule your complimentary retirement strategy session.
Thank you so much for listening to the Retirement Compass radio show. I'm Mike Bauer, joined by Zach Vancas, financial advisor at Stonebridge Wealth Systems. You can reach them at 866-295-5146 or go to stonebridgeiwm.com. They have 4 locations in Nebraska if you want to stop by and get a meeting with them in Kearney, Grand Island, Omaha, and Lincoln, or you can always do that through the magic of the internet remotely, wherever you are, stonebridgeiwm.com. We often talk about retirement risks and taxes, and there's a tax that popped up the other day that caught my eye, and it's called the widow's tax. Help me out here, Zach. What is this? And I'm doing the radio air quotes. What is the widow's tax?
What the widow's tax is, and unfortunately it's something that's often overlooked by most couples. You know, we have the unfortunate reality that when you have a couple, you have 2 people, and the statistical odds of them both dying on the exact same day are not very high, right? And yeah, this is a morbid section, I get that, but unfortunately, it's the reality that we all face.
Truth over comfort, right?
Truth over comfort, yes. One of the core values at Stonebridge is truth over comfort. And so the odds of both passing away on the same day are not high. So what that means is eventually you're going to have a situation where you have a single person. And the way the U.S. tax code is set up is you've been for probably, hopefully, decades at this point, because you have a long marriage, you've been filing married, filing jointly. And you have all the benefits of filing married, filing jointly. You have special benefit on Social Security. You have, the brackets are the way they are, the standard deductions the way it is, so on and so forth. Well, when one spouse passes away, now you're filing single, meaning your standard deduction just got cut in half.
So there's no special filing widowed category or anything like that.
I mean, you get to file married that whole year. So like if they pass away on January 2nd, that whole year you get to file married. That's kind of your grace period. But then the next year, you file single. And you have now half the standard deduction. You have tax brackets that got slashed, so where you move from the 12% bracket to the 22% bracket, that's not the same spot anymore. That gets shifted way lower. The threshold IRMAs, income-related monthly adjustment amounts, where your Medicare premiums can potentially go up, that's based on your income. Well, those brackets go down. They get shifted down. And the reality is when one spouse passes away, you have basically, we'll say, half the tax forgiveness, but the income doesn't necessarily get cut in half. Yeah, you've got Social Security for both people, and the survivor gets the higher of the 2, but not both. So let's say one spouse is making $3,000, one spouse is making $1,000. The higher earner passes away. Well, the survivor gets the $3,000. They don't get all 4, but they get the $3,000. If you have any joint pensions, those can continue if they're joint. And then if you have IRAs, 401ks, and you're getting your distributions out of those, your required minimum distributions, those are still coming. So the income doesn't change that much. Only the forgiveness from the IRS dramatically does.
Yeah, and thank you. That's the widow's tax. I mean, obviously, the math of it is that most people are gonna, in your marriage, somebody's gonna outlive the other one. My folks are having this conversation, and kind of an uncomfortable amount for me now in terms of talking about, I'm gonna outlive you. I'm gonna outlive you. It's like, okay, guys, this is awkward, but as you mentioned, truth over comfort. That is, get ahead of it. What do taxes work in, and you mentioned in terms of the different brackets, even though the income has gone down, sometimes because of the moving to a single, that can, and you just kind of, you said 12 and 22. I mean, that's almost double. And then 24 is the next one.
Mm-hmm. Yeah, we see it all the time where the income does drop slightly. However, the bracket can go up. dramatically. You know, we'll see all the time, we'll forecast it out, and we'll have, you know, both spouses living to age 90, and let's say they live 2 years apart. Okay, well, that means one spouse passes away 2 years before the other. And you'll see oftentimes a huge spike in those last 2 years of life because the tax, the income went down a little bit because, okay, you lost the smaller Social Security, but the income stayed relatively close, and then the brackets got shifted. Additionally, you know, there's situations, depending on you specifically, where we've seen the income go up tremendously because let's say you have a couple. Recently, we were working with one where most of their income came from, you know, a pension that he had and a VA disability pension that he had as well. When he passed away, a lot of that income went away. So their total income dropped, but like the VA is tax-free income, so that really didn't change much. But the income went away. Well, she still needs money to live. And so what does she do? She draws a higher amount from the 401k or the IRA that historically she hadn't had to touch. Well, any money that comes out of a tax-deferred instrument like an IRA, that's now income to you. So she's spending the same amount of money a month. All she did was rearrange where it came from because he passed away. Boom, income skyrockets, taxes go up.
I mean, and your mortgage isn't going down. Your life expenses, you know, groceries don't all of a sudden cost half as much. I mean, maybe you're buying less groceries, but you know, I mean, your bills every month, your car payment, it's not going to be all of a sudden cut in half. You know, for people that are listening, that's the widow's tax. It's one of those risks that's very fixable if you plan for it early. The team at Stonebridge Wealth Systems, Zach and everybody at Stonebridge can help you figure that out. It's very difficult to work around once it's already happened. That's for sure. Call the team at Stonebridge Wealth Systems, 866-295-5146. You can always go online right now. Take a few minutes if you want and go to stonebridgetaxbill.com. That's stonebridgetaxbill.com. They have a complimentary tax tool calculator. It'll show you what your tax picture may look like in retirement. And, you know, you brought it up, Zach, a little bit about those retirement accounts. So, I mean, the good news, okay, let's say that you've got a large 401k or IRA. The bad news, though, is that can actually sometimes make the problem worse because now you're paying a tax, as you illustrated, you know, that wasn't on the VA benefit, that it was tax-free, that now all of a sudden it's got, you know, ordinary income.
Yeah, like you said, having a boatload of money in that tax-deferred bucket's helpful. You know, you have money, but you don't necessarily have the same flexibility with that, you know, because of the taxation side. Now that you're filing single, the taxation on it's even worse than it was before. And so one of the big areas of planning is figuring out how do we get a little more diversity in our where the money is, not just how much we have. Like having $1 million 401k is awesome. But having $1 million net worth, some of that's in Roth, some of that's in 401k, and some of that's in a taxable bucket, that's even more awesome because you have the flexibility. And when you need income and you have a significant life event like that, like a spouse passes away, and your brackets are going to shift dramatically, well, you've got that Roth money or that taxable money that you can draw on, and you don't have the same tax impact. The downside is, if you don't do a lot of planning ahead of time, trying to do something like a Roth conversion, for example, where you take money out of your IRA and move it to your Roth, it's taxable to do that, but you do that on the basis of I'm going to pay at a lower rate today so I don't pay a higher rate tomorrow. Well, if the spouse has already passed away and you're filing single now, you know, that opportunity has shrunk now tremendously. So that's why it's so important to get in front of these situations and try and diversify it. Well, where's the money going to come from? How am I going to get it? What kind of income am I going to have? And having income plans in place ahead of time as well. You know, if you're looking at setting up a pension, you know, you're 60, 65, wanting to retire, and you have a pension you can turn on, and you're faced with, well, do I do my life only, or me and my spouse? You know, that's a real decision that has to get made, and it depends on your situation, but that's why it's important, you know, to talk to somebody, because that can be a massive, massive difference.
If somebody's listening right now, and we're talking about the widow's tax when you know one spouse outlives the other one, which mathematically speaking is likely to happen. If somebody's listening right now, a married couple, what are some of the warning signs in their situation that they can, you know, take some time today and kind of, you know, maybe go through some of the paperwork, log onto the websites, and look and say, hey, you know what? These are the questions I need to ask Zach and the folks at Stonebridge.
I'd say a few not directly related to the widow's tax, but in a way, big questions. A, the obvious, just estate planning. Make sure your beneficiaries are up to date. Like, make sure your wife actually gets your 401k when you pass away. Like that's a good start. Also, making sure both spouses are on the same page. Now, yes, I understand in every relationship, mine included, typically one spouse is more, in tune with the financial side than the other, right? And that's okay. I mean, obviously in my house, it's me. I'm a licensed financial advisor. My wife, not as hyped as this about this stuff as I am.
If you said your wife was, I'd rather be speaking to her right now.
Yeah. No, and that's fine. But my wife knows about our money. Now, does she know all the different metrics of our portfolio? No, but she knows where our money, the custodian we have, the bank it's at. She knows what our income looks like. As we start, getting into that retirement conversation, she'll know if we have any pensions, where are they? How much are they? Is there a spousal benefit? Do I have life insurance? How much is my life, right? They need to know, and both spouses should know at any given point, if I die, what do you get? What do you keep? What continues? What goes away? Like, that is just essential. And unfortunately, when people come in here after a spouse has passed away, that's the number one thing we talk about, is just figuring out what we're going to do, because they don't know. It's understanding, well, what do I get? What do I have? What am I going to get? What am I going to lose? What's going to happen? Because they don't know. That's I'd say the biggest thing you want to get in front of, and the biggest questions that I'm going to ask you, and we have to figure out together. Once we know that, and you have an understanding of, okay, if one of these spouses passes away, what's going to change? Now begins the planning part of, okay, if spouse A passes away, you're going to keep this, you'll keep the higher Social Security, you'll keep one pension, but you'll lose the other pension. But you will obviously have all the retirement assets. Okay, well, what does that give us as a monthly income? Let's say we're going to keep, after the spouse passes away, we're spending $6,000 a month, and we're going to keep $3,000 in income. We used to get $6,000, but now we're going to get $3,000. Okay, where do we get the other $3,000? Where's that going to come from, right? And that's where the planning starts of, okay, how do I get that? Is it distributions from the retirement accounts? If so, which accounts? Do we look at some fixed income instruments like an annuity? Is that something we could do? And obviously the easiest way to do all of this is to set it up ahead of time.
Yeah.
It's to have this planned out. It's to know, okay, one day, unfortunately, like I said earlier in the show, I can't guarantee a lot, but one thing I can guarantee is we're not all getting out of this alive. It's an inevitable reality, guys. Like, it is. I'm sorry. And you owe it to your spouse to have a plan of what's going to happen if you pass away, and vice versa. So getting in front of this so they know and they have the reassurance of, okay, if something happens to you, I will be okay. I mean, you owe it to them. And that's why sitting down with us, that's one of the big advantages of working with a holistic planner, is it's not on them. When they're navigating this terrible time and going through this grief, they don't have to figure it out on their own. We know. We set up the plan. And I, unfortunately, this month have gone through this process twice now of a new widow comes in upset, and we get to sit there and look them in the eye and say, hey, we're good. This is what we did. This is what's going to happen. You're going to be fine. And that's why it's important to sit down with somebody like us.
Yeah, I mean, if you're married and you've never modeled what your financial picture looks like with one income instead of two, it's a conversation worth having now while you still have options. Call Stonebridge Wealth Systems, 866-295-5146. They also have a great tool online at stonebridgelegacy.net. They have a legacy and estate planning readiness quiz, stonebridgelegacy.net. Always available to schedule a complimentary consultation at one of the locations in Kearney, Grand Island, Omaha, and Lincoln. You can go online to do that, stonebridgeiwm.com, or just grab your calendar, pick up the phone, and call 866-295-5146. For Zach Vancas and everyone at Stonebridge Wealth Systems, I'm Mike Bauer. Thank you for listening. We'll see you next time on the Retirement Compass.